Good morning, everyone, and welcome to the DecisionPoint Trading Room, this April 24th edition of the DecisionPoint Trading Room. I've been told I need to put the date at the beginning. All right. My name is Erin Swenlin, and I'm here with my dad, Carl Swenlin, and we are here to get you all prepared for the week. We have a lot of information to share with you. So, Dad, I'm just going to pass it over to you. I know that you usually have a little something you want to talk about beforehand.
It's going to be in the midst.
Okay, sounds good.
Let's start out with the SPY, the S&P 500. Right now, you can see we're down slightly, but we've been within a less than 3% range for 3 weeks now, and that's getting tedious. The PMO has topped, but it's not a really vigorous top, but that basically shows the power that's driven it up is backing off. PMO, all things being equal, will stay at the zero line. And so when it's moving above the zero line up, that's straight power. When it's moving down below the zero line, that's straight weakness. So we added a panel to this chart that shows relative strength of the SPY versus RSP. SPY being the cap-weighted version of the S&P 500 and RSP the equal-weighted version. So notice that they've been running together pretty much neck and neck, except for this one point, beginning of March, we had about 2 weeks of where the cap-weighted version was stronger. Normally, what we look for is at the beginning of a major rally, we expect the equal weight to outperform the cap-weighted version of the index. Okay, let's look at a one-year daily chart, bar chart. Back here is in October is when the low of the bear market hit, and we've been in a bull market as of this top right here. There's been a pullback, so we still have a bottom above a bottom, and in order for this uptrend to continue, we need to get another top above the top. And I was going to look at weekly and monthly charts for a change. The weekly chart is bullish. We've got a rising weekly PMO, and we've got, again, the rising trend showing that we saw on the daily chart. But we've got a problem right now is that this top is lower than this top. So it's got to get above there, or we're going to be in trouble with another downtrend. And the monthly chart, monthly PMO is still falling. That's long-term bearish, of course. You can see secular bull market rising trend is still intact. And my opinion is that this bear market is going to kick in again. And I think eventually we're going to go down to at least here. Let's check it. From the top, that is a decline of 60%. The next potential low would be 67% at that level. And then finally, this would be really the worst case, that's 75% decline from the all-time high. That I'm looking for that, for at least, like I said, here. I show this chart occasionally to remind everybody that in a secular market, we can have cyclical bull and bear markets. Here's the 1929 to 1932 secular bear market. There were 6 cyclical bear markets within that span, and also 5 cyclical bull markets. And they were all, there was no question that they weren't close. They were all well within the limits of what you expect. So I think we should be alert for this. We've had the bull market, not necessarily this magnitude, but we've had the first leg down. We were, I think, completing the bull market leg. Again, not to this magnitude, and I think we're headed down again. Let's look at gold. This is the weekly chart of gold, and notice we've had 2 attempts to go higher. Well, actually, this is an all-time high here. We had 1 attempt to exceed that, and now we've got another attempt coming. Notice that this advance here was vertical, and that's not ever good. I mean, it's nice to get up there, but it's probably going to take back a lot of that before it moves higher again. And here again, we've had another advance that was vertical, trying to beat that out. But this advance, we've had a good correction, and now this advance is much more organized and orderly, and good chance that's going to go higher. I mean, it seems to me the way the dollar is being beat up right now because of the kind of money that Congress is spending, I think the gold is looking really good. The dollar, not so good. We had a question about what's going on with the dollar in the email to Erin, and right now on a 1-year chart, notice we've got the decline, attempted rally, and it's backing off again. If you want to really get a long-term look at the dollar, you need to look at this symbol. It's a $USD, which is a cash settle of the US dollar, and we've got some really good historical data there. But notice back in the 80s, we had a vertical parabolic advance, and that was when the dollar was very strong, and then bang. Parabolic advances usually result in very steep declines. Here we had another one, not quite as steep as these 80s, but again, another decline. Now we have another parabolic advance and a breaking down from that. So I'm looking for lower numbers on the dollar. Oil moving in a trading range for the last 6 months or so, and backing off from the range and now heading higher. We'll see. It looks like we're getting a bottom above the signal line. That's always bullish, but it tends to run out of steam sometimes pretty quickly. So we've got to watch that, but expecting higher at this point. Treasury bonds got a rising trend, but this is the 20-year plus bonds, and they've been at a trading range for the last 5 months or so. Yields, 10-year Treasury, is in a declining trend channel, but it's not a very steep one. And again, it's rallying higher. And my expectation is that bonds are going to decline and the yields will go up. When we look at the yield array showing the yield lines from the 1 month to the 30-year Treasury bond. notice that this is the 1 month bond got up in 4.75, and it's really crashed. So, but the 3 month is actually the highest at this point. It's got the highest yield at 5.14, and the 30-year is just below it. But we've got an inversion, of course. This is a section from our DecisionPoint alert. We track the mortgage interest rates and basically showing how the interest rate increases are killing the real estate market. And this was January of 2021. This is a fixed payment table here. This is showing at the low of 2.65% of $500,000 mortgage payment was $2,015. To maintain that payment, unless most people buy houses not based on the price, but based on the monthly payment. So if that's the max this person can afford, at this point in time, the interest rate is now at 6.39, and this is the size of the mortgage, which is 35% less than it was in 2021. This mechanism here, it's incredible to me that the Fed could have screwed this up so badly, but they really have. We have another table here which shows if you want to maintain that, some people can afford a higher payment. So in order to get that $500,000 mortgage, it currently costs $3,124, which is 55% higher than it was in January of 2021. This is the real of the mortgage interest rate chart, the 30-year fixed. So went up very steeply, and it's basically consolidating, and we expect it'll go higher. Bitcoin, this dark line was where I thought it would stop, but it actually broke above that line, and now you can see there's another line of resistance that is pretty well defined as well. And let's go back and look at a closer in. Here you can see where that first thick line, where it got above that, but it's broken down below it. So this doesn't look good. PMO is now falling. So we'll be looking for lower prices on that. We had requests last week. We never got to it for natural gas, UNG. And UNG, I got interested in it right here after it had gone broken up out of this low, but it's come down lower. And I'm not so much a technical trader on this right now. It's more like I have a position, and I believe that it's going to eventually pay off, but I have no technical basis for that, except it's near all-time lows. That's pretty weak, but that's the way a lot of people pros trade. And
at this point, I mean, I did talk about it last week while you were gone, but we did get that PMO bottom above the signal line, and
that's
it looks better than it has for quite some time, I have to say.
Right. Let's see. I have this up. Oh yes, I wanted to show. We have our earnings chart showing GAAP earnings. That's generally accepted accounting principles. And that's what you should use. But right now, we've got a PE of 23.93, almost 24, which is well out of the range let me go back a chart. This is just an illustration at one of the other bubbles we have, which is earnings. This is the top of the range, PE of 20. This is normal range. PE of 10 is the bottom of that range. And right now we're well above the range. And I think I've pretty much covered it, unless there's anything else.
I'll let you look through the questions. We did have a question on UNG, and I think that has been answered, so I'm going to get rid of that one. How do you trade pullbacks in general terms? So there are more possibilities that it is going to work. I think I'll cover that one on my section. For the mortgage calculation, why are you fixated on absolute rate of a 30-year mortgage? Very few people would have had that rate. Why not use a weighted average for the year? I'll let you speak to that, but
yeah, I'm not.
It's not so much to say that like everybody got that at that low rate. It's really just a comparison of, had you gotten at the lowest, this is what it would be like.
Right. Well, all the people that bought at that low rate are now locked in to their mortgages. They can't sell because they're now underwater at this point. With the value of their house is coming down, and their mortgage is based on a home value much higher than that. So I'm not quite sure how you would look at it any other way. The point being is the higher the average, the mortgage rate goes, it's locking in people who bought at a lower rate, and it's deadly.
Yeah, I mean, I got lucky on my refi, so I'm actually lower than what is showing there. But I definitely don't want to jump into a new mortgage at this point for a new house or anything, just simply because I'm never going to get that rate.
Right.
Thoughts on semiconductors? I can cover that one unless you wanted to look at that chart. That's pretty much that for the questions.
Okay, good. Then I'll let you have it.
Then you will let me have the screen. You got it. So for my section of the trading room, what I always do is after Dad goes over all of the, the market in general, I like to go in and I start diving into sectors. So here are all the sectors on a candle glance. And as I always do, I tell you to take a peek and really pay attention to those PMOs and what they're doing. And when you look at this chart, honestly, there aren't too many sectors that really are appetizing to me, because we have a lot of these PMOs slowing down and looking like they want to turn over, or like in the case of XLC and the case of XLK, we have negative crossovers that are already in action here. Consumer discretionary is very close to a PMO sell signal as well. So those certainly are three of the most aggressive groups: comm services, discretionary, and technology. And those are the three that are failing right now. Well, where is the strength? The strength is in the defensive areas of the market, which would be consumer staples, where you can see the PMO is starting to pick up speed to the upside on this breakout. And you can see utilities. Well, the PMO isn't looking quite as healthy as it did on Friday, but certainly it is on a buy signal still. Energy, I do like that it is starting to make that turn. We got a bottom above the signal line on the PMO and a short-term breakout, so I like the look of that. Healthcare still looking healthy, if you will, breaking out from what looks like a somewhat of a flag formation there. So healthcare is considered somewhat defensive, and so we are seeing some action there. Financials, looking interesting. I have been kind of avoiding this area for my subscribers simply because I think the risk factor is just a little bit too high for me. With the banking crisis hasn't completely sorted itself out. Obviously, we got a nice rally out of that low, But the big problem is for me is I just don't want to be holding something in that sector and then the banking crisis rear its ugly head. And there you go, you're stuck and the price drops on your stock, whether it's a bank or not. That is why I've been staying away from financials. But admittedly, they are doing pretty well out of that low that they had in March. So what I want to concentrate on really is consumer staples. I did your daily 5 this morning, and I did talk about it then because it is one of the sectors that I think looks pretty good. The PMO isn't quite overbought yet. Industrial is looking interesting, but the price action on consumer staples is really looking the most interesting. And I could say that healthcare's price action looks pretty interesting right now on that breakout from that declining trend. So really, I think these two sectors are where we might want to concentrate this week, but in particular, consumer staples. So let me show you those good charts here with those under the hood indicators. For those of you who are not subscribers, these charts that we're showing you, the ones that my dad went through for the DP alert and these sectors and select industry groups, we also have what we call under the hood indicators for. All of these charts are available to you if you are a subscriber at DecisionPoint. All you have to do is go to that blogs and links page, and those sector lists, the DP alert list, you're going to find those all in here. We're getting ready to redo these a little bit, but we'll talk about that another time. So if you aren't a subscriber, I definitely welcome you to come check out the website. We do have a new video up that will give you a more in-depth look as to what we do. So definitely go by and check that out. But those charts that we're looking at are available to you on the DecisionPoint website. All right, so consumer staples. So again, nice little breakout. And it's not just a breakout from on a gap here, which is good. I think it's more of a breakaway gap than anything else. But we have the breakout above this high back here from 2022. I think that that's very positive for consumer staples. We do have to be a little careful because price is overbought just based on the RSI being above 70. And looking under the surface, we have very strong participation readings right now, and they are staying pretty steady, moving sideways here. I would like to see this silver cross not look toppy though, but it is just flat right now. So we'll see if that continues, but a 78% reading on the silver cross index is good. I didn't talk about what the silver cross index is. You're familiar probably with the golden cross, which is a 50 and a 200-day EMA positive crossover. But we also have what we call a silver cross, which is a 20 and 50-day EMA crossover. And all we do with the indexes of these is we count up how many within that sector or index have a 20 above the 50 for our silver cross index. How many stocks have a 50 above the 200? That is our golden cross index. And these are really excellent for breadth. We're finding them to be very successful, particularly the silver cross index.
Yeah, percentages.
Percentages, yes, my bad. So definitely a nice look here on these percentages. They are higher than 50%. So I think that under the hood, consumer staples look pretty good. Look at stochastics just staying easily above 80, which suggests internal strength. So and there you go, relative strength starting to pick up as well for this sector. And then the other one we were going to look at was healthcare. We're not quite out of this declining tops trend line. We haven't broken that yet, but the very short term we certainly did, and it does look rather flag-like. So I'm hopeful here. But notice that the percentages aren't quite as high as they were in consumer staples, and you can also detect kind of this top and a little bit of fading of that participation under the surface for healthcare. We do have some pretty decent outperformance here by the sector, but stochastics moving back below 80. There's just the strength on this chart is just not as well. It's just not as strong as consumer staples right now, but I certainly see some possibilities. But the big thing is, Carl talked about the problems that we're seeing in the market right now, and we're very concerned about big, deep declines coming up. And that's really going to take everybody with it. So we really have to be careful, because while we have these pockets of strength in staples and utilities and healthcare, they're going to still be subject to the winds of the market overall, which is why the DP alert is so important. We really need to know where the winds are blowing. And right now it's just looking very, bearish, I guess is the best term to use. And so we would really want you to be careful about expanding your portfolios. And really, when things start to look ugly like this, or just, you're not really sure where things are going, but they don't look good, it's a good time to tighten those stops, maybe take a little bit of profit taking. Expanding your portfolio at a time like this is very difficult and very risky. So definitely consider that before you start expanding things, because things aren't looking that good under the surface overall. All right, so let's go ahead and let's see, it's almost 9:30. Let's take a quick peek at the industry groups. And then I do have since I did your daily 5 this morning, I do have a diamond of the week to share with you. But let's go down to consumer staples, take a look inside at where is the strength lie, where is the weakness. Well, currently personal products looking good. Notice these PMOs when we flip through stochastics where they are. This is a nice strong chart for personal products. Brewers up against overhead resistance. And while that looks positive here, I know people would say, oh, that's a big double bottom. It isn't actually, because double bottoms are reversal patterns. They really should come off of a big decline. We're not seeing that. You could maybe make a case for a triple bottom coming in here. But overall, I would just be careful for brewers. They're getting up against that overhead resistance. Food retailers and wholesalers trying to have a nice little breakout there. Your PMO is now reversed and moving higher. Stochastics just above 80. Food retailers and wholesalers looking good. Food products looking kind of toppy. PMO topping out here, and stochastics dropping below 80. So if you're going to be in that sector, you don't want to be in food products. General retailers looking very healthy here. Stochastics above 80, the PMO rising, and I like that break above the 200-day EMA. Non-durable household goods, big breakaway gap here above overhead resistance. PMO accelerating higher after a bottom above the signal line. And you can see stochastics, although they broke down below 80, are already trying to move back up. I really like the looks of this non-durable household products chart. PMO turning back up here for drug retailers, but I don't think this is quite as bullish as the other charts we've looked at. Soft drinks, having a really nice steady rally, but it does look overbought. Looks like it might need to turn back down. PMO looks like it's decelerating just a little bit. This would be a great place for a pause or a pullback, just because it's near that overhead resistance. Tobacco had a big decline last Thursday, but is surging here. We've got it back above the 250. Both the 50 and the 200-day EMAs, as well as the 20 PMO looking like it's going to bottom above the signal line, but stochastics looking a little bit iffy there. So probably would avoid this group. And distillers and vintners, PMO is topping. Certainly not a group we want to be interested in. All right, I'm going to bring you my diamond of the week. And then once we do that, we will take your symbol requests. So hopefully those are piling up in there. So here is my diamond of the week for you, and that is Dollar General. Most of my diamond members are aware of this chart, as we talked about it on Friday during our subscriber-only trading room. So I did bring this to the table to them before this morning. You can see that we have a nice breakout. I wasn't really thrilled with that filled black candlestick, but certainly I think things are looking good today with that breakout to the upside on a bearish candlestick. We have pretty much a textbook reverse head and shoulders on this chart. You can see the PMO is rising. It's almost above the 0 line. RSI is positive above that net neutral 50, and stochastics moving above 80. Relative strength improving for the group and for the stock against the S&P. I think this is looking like a pretty good pocket of strength, if you will, in the general retailers area of consumer staples. So that is your diamond of the week. And now it's time to look at your symbol requests and answer any questions.
Okay. This is odd. Okay. CL.
Okay. And here you go, personal products, which did look pretty good on those industry group charts. So a good pull here. We have a really nice PMO bottom above the signal line, a surge, if you will. We are starting to call those surges when you get that bottom above the signal line. And the PMO is getting a little overbought, but really I like the look here. It looks a lot like the consumer staples chart itself. We have a bullish engulfing candlestick coming in off of a filled black candlestick. On-balance volume confirming. Stochastic is above 80. I have to say, I really like this chart, and it's in an area I like. So let's go ahead and take a quick peek at the 5-minute candlestick. This is where we do the actual trading. We're looking for the best entries and exits. And what I have found is using a 5-minute PMO and a 5-minute RSI, we can time our entries pretty easily. And these indicators are readily available on StockCharts for you. Let me go ahead and put my inspect tool up here. So a conservative entry on a 5-minute candlestick chart is a 5-minute PMO crossover combined with a positive RSI, or an RSI that is above 50. When you get that, that becomes your entry point. Now, if you're looking at your 5-minute chart and you want to get rid of your stock, the sell points are really easy. It's as soon as that PMO turns over, that is going to be your sell point. I usually, when I come to a 5-minute chart and I'm ready to sell something, I just need any excuse. And this would have been my excuse to sell it right here. And that would have gotten me out at a pretty nice area, particularly if I'd gotten in on this candlestick where we had the conservative buy come in right there. So you can see how timing the entries and exits with these indicators can be very helpful. Lots of gray area. You can obviously get in if the PMO turns up and you don't have the positive RSI, but I'm finding that those aggressive entries don't always pan out, whereas these conservative entries tend to, you tend to do all right. So Colgate-Palmolive not on a buy signal just yet. We have that 5-minute PMO in decline, which tells me that it is vulnerable to lower prices, which means that I can get it at a better price. So I would say that the buy point isn't quite in, but I would be watching for that PMO to just turn up at this point because price action looks very positive.
Okay, PDI.
This is an ETF mutual fund, it looks like. Okay, so we have that PMO reversing back above the signal line. We have the RSI moving above 50, stochastics rising, and they are also above 50. This is early on this move. We only have the 3 days. It looks like today might be a follow-through day for us above the 20-day. Everything's going well here. I would just say that it's still a little bit on the early side, just based on the way RSI and stochastics have only just gotten above the 50. But this looks pretty good. We're just up against this overhead resistance. This tells me that there's a good chance we're going to see a pause or possibly a little mechanical pullback going on here. So it's a little early for me, but I do notice it has an excellent yield. So, you can't sneeze at that for sure.
Yeah,
So
but the PE and the earnings are negative.
Negative.
So the yield is, forget it.
Suspect.
Definitely do some more digging on that, that's for sure.
Yeah. The weekly chart, I mean, certainly this is a reversal point down here where you could see a steady reversal, but that that weekly PMO is still in decline. I think this one still has a lot. You're still kind of a vulnerable on this one to a decline, but this looks nice. If I owned it, I would certainly be holding it, probably setting a stop below this level of support. Nice tight stop at about 3.3% might be a good way to go with this one. But it does look like it's going to break out. All the indicators are acting like that. I just think it's a little bit early on, for me anyway.
Okay, take a look at the Q&A window for the next question.
Okay, so we looked at PDI. How would you analyze leverage closed-end funds? I would still, I don't know about you, but I mean, I would still follow those technicals, even though they're closed ended. It shouldn't matter really what the technicals are on that. And here's another one. So the aggregate bond fund, I would warn that I think bonds are going to be moving lower and interest rates moving higher. So that this particular one would bother me a little bit. But it's similar. We talk about the closed-end fund, PHYS, and it's still the same thing. You're going to look at the chart. You're going to look at those technicals. If you want to make comparisons, I don't know if I can do that with this really quick. Let me see. You can check the relative strength lines. That might be a way to at least, determine of the three which one you'd like. Certainly PDI is starting to see some movement in relative strength. AGG, not quite the same. It's improving relative strength, but not as much as on PDI. HYG, starting to see some outperformance here. But honestly, when I look at them, I think PDI has the best relative strength look here on it. So that relative strength might be a way to help you determine which ones you like.
Okay, RNA.
Biotech company here. Oh, those big gap downs always worry me because that means I'm vulnerable to those on the other end here. Kind of cup with handle-ish.
You might want to look at the biotech under the hood chart.
Yeah, that's a good idea. So this one, I like the way the indicators are acting for sure. Certainly outperforming the market. It is getting above the 20. I think my big heartburn with this is all of the overhead resistance here. We have overhead resistance at this gap. We have overhead resistance at the 50-day EMA, followed by overhead resistance at the 200-day. This one has a lot to get through, and it didn't survive very well at the end of March. So I'm not as thrilled with this one as some of the others, but I think you're right. Let's look under the hood at the biotechs. And I will say, looking at IBB, that I do happen to own IBB right now. Well, so let's see. I mean, it's obviously not having a very good day. Relative strength is still moving higher. We're still seeing some increase in participation. These numbers are a little on the low side, but they're higher than the Silver Cross. So you can see the Silver Cross is moving up, accelerating a little bit higher here. What I'm going to be watching as an owner of IBB is I want to see this participation continue higher, or at least if it stops, stay about even like we had back here. I don't want to see anything that looks like a turnover on that, because you can see when its participation starts to turn over, a lot of times that's going to be at a major reversal point. So that's what I'd be watching for on IBB. But I'd say that there certainly are still winners out there in that particular sector. The majority, in fact, are showing above their 20-day EMA. But it's as with all of these, we are vulnerable here to a major market downturn in all of these stocks and ETFs. But at this point, I think IBB is looking healthy enough.
EELL. Hell.
All right. So this was a reader request in DP Diamonds about a week and a half ago, I think, not last week, the week before, possibly. And it didn't turn out to be that good. And I did present it because it did have some possibilities, but it almost immediately hit its stop. So I got out of it. I mean, I didn't get into it, but I stopped paying attention to it. The stop was hit. It looks pretty good as far as a reversal coming up, maybe a reverse head and shoulders, but this is early. I do like that thrust here on the PMO, that surge with that bottom above the signal line. And RSI looking good. I do not like stochastics. Stochastics to me are more of an early warning system and our early detection system if we're looking for a move to the upside, and they are still moving down. And so that would make me a little nervous about getting involved in this one. But if you happen to own it, today's rally is encouraging, and the indicators are turning around fairly quickly on today's rally. So I would want a tight stop. Keep in mind, this is a really low price stock. We're almost getting toward the penny side of things. So you need to position size wisely. You could buy a ton of shares in this, but I would recommend not doing so. You're going to see a lot of swings because it is so low priced.
Okay, how do you trade pullbacks in general terms so there are more possibilities that it is going to work?
Well, I think, Fernando, one of the things we're looking at and learning are these PMO bottoms above the signal line. We've got the pullback. If we get the bottom above the signal line, if you never got that sell signal, that's a pretty good sign, that you might be going to continue higher off of that pullback. So I think that's one of the ways we can look at it, is following what the PMO is telling us. And then also I would say on some of these, I'm going to look at AMAT. Maybe we'll get lucky here and I can talk about trading a pullback. I think I can. So the PMO, I think, is really going to be where you're going to want to look on these pullbacks. And stochastics is another excellent place. Like I said, stochastics I'm finding are really great early detection system. They turn up before price and the PMO typically, and they do get some follow through. They're very short term for sure. But I think they set up a really nice story as to what might happen after a pullback. So we are getting this pullback on applied materials. It is bouncing off that 200-day EMA. Stochastics are telling us that this might be a good pullback with a move to the upside, but the PMO is not in agreement. The RSI is not in agreement. So 20 is dropping below the 50. So there's a good sign here, right, with that stochastics moving up, but we need to see that PMO rising or at least above its signal line on the pullback. And that'll give us a better sense of whether that pullback's going to work out or not. Long answer, hopefully a good one.
ANET.
All right. So AMAT, just so you know, I'm not liking. So I think semiconductors are going to be in trouble here. And here is ANET. Telecom equipment has been suffering a bit here. I believe AT&T might be associated with it. And they had a big decline last week. This one looks like it's turning over. I mean, RSI is telling you that it's weak because it's below 50. PMO is in decline. If I owned it, maybe I would try and hold it here while it stays above the 50, but set a really tight stop here of about maybe 3%, that if it dropped below that 50, that I would just be out. Like I said, with the market looking as weak as it does, I don't want to be involved in any stocks that are showing any kind of weakness. And this one certainly is showing weakness.
Okay, BAX.
All right, medical supplies. I've liked this area. I'm pretty sure this was Diamond subscribers. You can help me out, but I believe this was an industry group to watch a couple of weeks ago. Certainly Baxter looking good on a move out of the March low. I would say the PMO is very overbought right now, but it's certainly looking good. And we've seen the PMO well below -2. So +2 isn't really overly overbought, if you will. Stochastics above 80. I like this chart. The only thing that would be a little bit worrisome is that RSI is overbought. And, this stock hasn't ever gotten close to overbought this whole year, or at least most of the year that we're looking at. So
EPS are horrible looking. I don't know what's the
yeah,
story there, but I
going
would
on
dig a
there.
little deeper before.
Yes, another good sign that, be careful. But I do have to say the technicals are looking up on this one. Where's overhead resistance? I'd say that's the strongest level. And we've got how far away? We're about 6% away from overhead resistance where it might find some trouble. So maybe you go in thinking about a 6% gain rather than a 15 or 20% gain. Set a tight stop. But I do like the look of this rounded bottom. I think that covering this gap was real important. It did that.
Okay. BYND.
All right. Just wanted to take a quick peek at the 5-minute. No entries right now. Beyond Bed Bath and Beyond. Beyond Meat. That's right. Big rounded top here. Don't like that. PMO is in decline. RSI very negative. Stochastics. Not only are they below 20, which is a sign of internal weakness, a lot of internal weakness, they're falling. This looks more like a shorting candidate than anything else. Yeah, this definitely looks more like a short. A little just moving down to this level would be a 17% loss. I think you're very vulnerable to far more losses on this one. Like I said, if anything, I'd see this more like a short than a buying opportunity.
Got a question here. Why do you think semiconductors are going to be in trouble? Let me take a look at the under the hood chart.
I think there's a lot of reasons to think that semiconductors aren't going to do well. RSI negative. We had a rising wedge and price has fallen below that. We're both favoring higher interest rates.
All right. We've got the rising wedge formation, which is breaking down. There's still a rising trend line right below where price is now. And
Yeah.
So there's possibility that it'll hold there. But if you look at the PMO and OBV, we've got negative divergences. And same thing on the Silver Cross Index. And notice that there's a negative divergence there between those two most recent tops. Yeah, and then the participation in terms of stocks above the 20, 50, and 200, they're dropping off. So, there's money's moving out of there, I think.
Yeah. Relative strength is fading. I think that's the big problem I have under the hood is looking at that Silver Cross. It's had its own negative crossover. We're finding the Silver Cross to be extraordinarily useful on catching trend changes. And there you are. There's a squirrel out front, so it's very hard for me to control them right now. Okay.
3M.
3M. All right. All right. Well, we do have kind of a rounded bottom, sort of. Well, no, that's not very rounded. That's more of a little trading range here. And we're still stuck within it. Here is your resistance levels. And here it's kind of holding or support level here. It's not a real exciting chart, I guess, is what I would say. It looks like a hold because your PMO is still rising. RSI is now about ready to hit positive territory. Stochastics worry me, though. This looks like a nice little reversal today, but that's a filled black candlestick, meaning it is now below its open. So while it's higher than Friday, It's below its open. This one just has too many little weakness signs on it to me. But PMO looking good. So I think you could make a case to hold it.
How about weekly?
Oh, yes. All right. Well, the weekly PMO is trying to turn up here, but it's rather flat. Scooter is only 10%. So 90% of the large cap stocks are doing better than 3M. So that's not a good sign. RSI is negative too, that weekly RSI. This is a pretty strong level of support. I actually want to see a monthly now.
Yeah. Okay.
Yeah, we're kind of talking. So it needs to hold this level, period.
Definitely.
If we lose this level at all, you don't want to be owning 3M. This looks like a giant double top too. Not a good looking monthly chart. There's some possibilities here, but be really careful.
Let's see, AI.
C3 AI. Okay, a lot of talk about AI these days. So I'm not surprised you want to see this chart. Big decline happening today. Actually started on Friday. You lost support here at that 200-day EMA. Not a good sign, not what you wanted to see on Friday. And now we're getting what really makes sense as a continuation. Of course, not 11%. I'm sure that was unexpected. The chart is still going south. Next level of support. This is really the next level with the gap here and these tops. And that is another 10 to 11% decline. So if you're on board for that, you could hold it if you wanted, but I wouldn't be. I think I'd be with all the other sellers today. I don't like the look of this chart at all. And if we go to the 5-minute, it's not really in a sale where you want to sell it necessarily because the PMO is rising, but we're really not getting a whole lot of action out of that PMO rising. But still, I would not want to sell it until we got the turn on the PMO or we started to lose this little support level here. But I think you can maybe hold on to it for a better exit.
AMC.
Well, PMO is just turned over, so that's a bad sign. And RSI has now dropped below 50. This is in consumer discretionary. And of course, it was at one point a meme stock. I don't see anything positive on this chart. And that PMO topping right now, I might not wait for support to be tested here. The fact that this is going so south so quickly to me, not a good sign. I think I would be a seller here. And 5-minute chart, this is exactly the time to sell. Probably could have gotten out just a little bit earlier, but yes, topping 5-minute PMO beneath the zero line, I don't think you need much more as a sign to sell.
Okay, Amazon versus Google.
Right, that probably will cover it. So what I do for this or that is I'm going to look at relative strength primarily against a group and against the SPY, because that's that and the PMO's value can really give you kind of an idea of relative strength together. So let's remember Amazon is at about a 2.3 PMO, and we do have rising relative strength. It is trying to break out above a 200, but we also know that they have been laying off people and there are problems under the surface for Amazon. So we should keep that in mind too.
Okay, and then
Google, I got to compare it to Google still. And Google, same sort of not good setups here on the PMO, but PMO is at 2.72. So relative strength wise, it does have a little bit higher PMO. Relative strength is mostly flat though. When I make the comparison, at least the PMO on Amazon had a bottom above the signal line. But like I said, I don't know that I'd necessarily be a buyer of Amazon just because of the problems we know fundamentally. And I know I'm not one who follows fundamentals all the time, but that does bother me about Amazon. And I think that closes us out.
Yeah, I think we've got about another minute.
Okay, I will rush through another.
QQQ.
Which one?
QQQ.
Oh, well, shouldn't we look at our under the hood for that? All right, so under the hood indicators on the QQQ, look at that silver cross topping, and it is having a negative crossover. That is a really bad sign for the QQQ. I would be, that just alone makes me bearish. I don't even need to look at the rest because that signal is, those are really good signals. And this one is telling me that we're going to get a breakdown here. I think there's no other answer to that question on a symbol request.
All right.
Ooh, all right is right. All right, thank you everybody for joining us today. It looks like I got a little dark here. We enjoyed your company and your questions, and we hope that you return to come see us next Monday. And good luck and good trading. We all need it right now.